Hello and welcome. You're watching Business Today TV. I'm Sakshi, Batra, and this is a special edition where we're going to be talking all things economy. Well, the Q3 GDP data or the October to December GDP estimate is slated to be out tomorrow and will be given by the NSO. That's the National Statistics Office. The top banks, ratings firms, and broking agencies have all also given their own polls and estimates of the Q3 GDP, which are largely anywhere between 4.6 to 5%, higher than the 4.4% estimate that's been given by the RBI. But if this band comes true or anywhere in between, that would still be a moderation when you compare on a sequential or a year-on-year basis as well. The bigger question is that despite the macroeconomic uncertainties and the slowdown fears across the globe, does India still remain a bright spot with the upcoming Q3 GDP numbers? What we will try to seek to find out on this show is also how strong is the Indian economy currently, and how do we see that in the global context, and how will the policymakers, market analysts and economists really analyze these numbers going forward from here too. Joining in on the show with me are two very special guests now. Yuvika Singhal joins in. She's the economist at QuantEco. Also joining in is Madhavi Arora, lead economist at Emkay Global. And they will all help us with the insights on what to expect really tomorrow. Welcome Yuvika and Madhavi, and thank you so much for taking the time out for this discussion on Business Today TV. I want to start off by asking both of you, what is the number that you both are working on for the Q3 GDP? Starting off with Madhavi, for you first.
Hi. So we're looking at 5% for this quarter on the GDP numbers. On a value-added basis, we're looking at 4.7%. Of course, it's a if you look at the previous quarter, it's obviously a slower print versus the previous quarter, but obviously it is coming on a relatively higher base as well. Both with GVA and GDP, of course, the key risk to our forecast arises from the fact that there could be sharp data revisions. We had seen that in the last 2 years, which generally happens also with the release of each print. Yeah. But we are hoping that they are likely to be very significant because last 2 years also had the COVID disruption impact, which was leading to much higher revisions. But let's see how things pan out. I think because of the base effect being sort of weaker this time around, we are looking at a slower growth. But for the year as a whole, we are maintaining our GDP forecast at 7%, which is in line with NSO.
Okay, for the year, 7%, and for this quarter, 5% for you. Yuvika, how do you see the economy growing in Q3?
Hi, so we are in synchronous here. We are also looking at a 5% for Q3. For full year, we are slightly below NSO's estimate at 6.8, which is 20 basis points below NSO's estimate. I think the critical point here and how to read this particular GDP number would be that nevertheless, it will mark a slowdown with the Q2 of 6.3. But I think it's the Q-on-Q momentum which is expected to be fairly strong in Q3. And that is what would grab headlines once this number is announced, that while the YOY number is also 5%, and like I said, the Q-on-Q sequential momentum will also be close to 5%, which is a very healthy run rate for the economy. And I think we have to look at both the YOY and the Q-on-Q numbers in tandem to be able to derive the correct sense and the correct judgment of the upcoming or the impending GDP number.
Right. Madhavi, if you could expound upon the point where you left off at, like both of you are on the same page when it talks about that, from Q3 of FY22, which was a 5.4%, anything below that will be a moderation. The Q2 GDP growth was 6.3%. So in that context, also the estimates that you're working with would be lower. And that actually looks like economy is slowing and we are growing weaker. Does it really make sense to look at as this point, or do you say the base effect is going to play a larger part over here?
See, at this point in time, there are still mixed signals that we're getting as far as the economy is concerned. In fact, we've seen some rising capacity utilization levels, which again is a function of the fact that there could be a better domestic demand. We on the capex side, we are also hearing new projects announcement, which have risen almost 44% of the quarter led by the private sector.
Sure.
At the same time, we are seeing improvement in the rural employment conditions as well, which is also confirmed by the fact that NREGA, NREGA demand is also coming off. Plus, we also are seeing some improvement in rural wages as well. But there are also, a slowdown in other segments of the economy which are also visible. So at this point, I think it's still a very mixed recovery momentum. I think the slower growth trajectory will be more visible as we get into the second half of next year. At this point, I think it's too early to say that we're looking at a secular decline in the economy. It could still be very cyclical.
Okay. Cyclical and not secular. Yuvika, will Q3 FY23 GDP growth at 5% be seen as a good or a bad pace in which the economy is really growing at, according to you?
I think, Sakshi, if you look at YOY numbers, there has been a considerable degree of noise in these numbers over the last 2 years because of the pandemic, right? Because numbers have been distorted to a large extent because of stop starts of production and very severe Omicron Delta waves that we saw in the past years. Now, like I said, there is merit to look beyond the YOY number, which shows a moderation which is base-led. But if you look at the Q1 momentum, which is, like I said, is going to be fairly strong. And let's remind ourselves that Q3 was a quarter where we saw bunching up of not just pent-up demand, but even festive demand. It was a festive heavy quarter. A lot of consumer sentiment saw an improvement in this particular quarter. Also, if you would remember, CPI inflation prints for the months of November and December had come in lower. And I think cumulatively this quarter should see that services which had gained pace in a very meaningful way further gain traction, and all these facts, improvement at a sequential pace would get reflected in the Q1Q number, and then to some extent on the YY numbers as well. And that is how this recovery should be seen, that at least up till Q3 the momentum in the Indian economy remained fairly strong. And not to forget that this was against a backdrop of global growth, which we now expect to do, better than where we were almost a quarter ago. But Q3 was the point in time where global growth slowdown was getting, more marked. Calls for a recession were increasing, and in such a global environment, if the Indian economy was able to maintain its growth momentum in Q3, I think it is to be seen in positive light.
Absolutely. Madhavi, you said that 5% is what your expectation is. Which are the sectors that are likely to lead growth in this quarter? Is it going to be services again? And what do you also expect in manufacturing, keeping in mind that the Q3 numbers of large part of India Inc. did show some pressure on the bottom line and on the margins too?
So I think this time around we are seeing industry GVA to have moved back into expansionary trajectory, somewhere close to around 3.5% kind of number that you should see, as against a contraction of 0.8% last quarter on a Y&Y basis. I think services continue to remain a leader in terms of its contribution to growth and in terms of its absolute YY numbers versus other sectors. But again, that is still going to be relatively slower than what we saw in the previous quarters. That said, of course, the sector is still enjoying the full impact of reopening, and I think will continue to remain above 6% in the coming 2 quarters as well. Agriculture, I think, should be somewhere in the league of 2.5% to 3.5% in the second half of the fiscal year. But the good part is that industry, would come back into the positive territory. Of course, a part of it is owing to the fact that the input costs this time around were lower, as Yuvika was mentioning, that on a sequential basis, things obviously, are better than what they were a quarter ago, partly on account of, much better corporate value add that we saw in this quarter. But of course, because of the base effect, things are looking a little nasty. And as, it probably would look to be a relatively slower, annualized momentum, but on a sequential basis, I think industry is one sector which, has sort of made a comeback.
Okay. Yuvika, to take the point that Madhavi has also just spoken about, and also to take her point which she mentioned in her earlier answers as well, we do expect the NSO to revise the FY 2021 and FY 22 numbers as well. So will the base effect itself change this time, and what can one expect here? If that changes, then in light of that, the 5% growth that you're expecting?
Honestly, Sakshi, that's anybody's guess. And, as economists, it's very hard to predict which way the revisions will be. So I would not hazard a guess there. But I think to add what Madhavi said, I think, yes, services will once again be the growth underpinning for this quarter. We have to remember that the industry sector, and within that manufacturing in particular, we do expect a swing from a contraction to a positive growth number for Q3 vis-a-vis Q2. And we also have to remember that this quarter, there were two opposing forces. On one side, industry did benefit from softening of commodities materially, which actually had worked against them up till Q2. But on the other hand, this was also the quarter when we saw export growth momentum slow down. And if you split the export basket and actually see where the export momentum slowed, it was largely single-handedly driven by manufacturing exports, whereas services exports still continue to do fairly good. And also the primary, which is the agri side of exports, have also held fairly well so far in the fiscal year. So the slowdown that we have seen in the India's exports has largely been manufacturing, and that could also keep the recovery in the manufacturing sector somewhat, the upside to be a bit capped, though the softer commodity prices are likely to benefit at the margin.
Okay. Madhavi, since we are expecting a moderation here, but despite at 5% GDP growth, which you expect, do you still see India as one of the better performing or one of the best performing economies in terms of growth across the world?
So, well, as Yuvika also mentioned, I think we need to reckon the fact that we have withstood global vagaries much better. I think we should actually see from the COVID period where I think most of the economists have written off India with double-digit contraction, which obviously did not happen. And India enjoyed, the foreign flow momentum because of the fact that we did better than what most expected us to do. As I said at this point as well, you're not really seeing very discernible secular trends which could actually say that India is looking at a much slower growth momentum in coming quarters. Of course, we will slow from our current momentum, but I don't think that we are looking at a much sharper collapse, a sharper correction than probably between around 5.5 to 6% for next year. Versus other economies, I think it's still in terms of absolute numbers. Of course, India has been a shining star, and I think it will continue in the coming year as well. But on an absolute basis, I think there are certain missing agents that still need policy support or some kind of attention.
Sure. Yuvika, will that also mean that India will continue to attract investments, say, over China or other major economies if we grow at this 5%?
Well, yes, Sakshi, I think that is something that is likely to continue. And when we talk to investors abroad, we do see optimism on India, and not just this quarter or this year, as we might be very myopic in our view, but they are largely betting on India from a medium to long term perspective. And I think given India's structural strengths, the growth story could feel much more healthier. Probably once the dust has settled on the global headwinds or the global uncertainties that we are seeing. We are above pre-pandemic levels as far as growth is concerned, and the kind of reforms that we have seen in the last few years, I think it will not be long before truly healthy growth resting on healthier balance sheets of both banks as well as corporates. The private sector capex cycle probably is just waiting in the wings. So, like I said, a better or a healthier, growth dissection, if I could put it like that, is something that is probably waiting in the wings for India. And I think that is what the investors are probably looking and betting on.
Okay. Madhavi, will 5% Q3 GDP print push RBI to shift more focus to growth versus inflation, or is inflation going to be the top priority even now?
I think RBI is quite comfortable currently with the growth momentum. They had not shown any kind of, concern with regard to growth being a worry at this point in time. I think they're very clear, at least in the Reserve Bank internal committee, they're very clear that a higher inflation is what actually impedes growth in the medium term. So I think sitting today, the policy focus is pretty much very focused on inflation being the demon around, and needs to be controlled to ensure that the sacrifice ratios of the output actually turns out to be lower. I think they're very clear on that front that inflation is going to be leading to a much lower output than the other way around.
Right. So what about you, Yuvika? The minutes of the latest RBI's Monetary Policy Committee meeting really revealed diverging opinions among the members of the panel. While some members stressed the importance of reining in inflation, the others cautioned against the impact of rate hikes on growth. So what do you expect?
I think clearly the Jan 23 CPI inflation number, which proved to be a shocker, has somewhat upset expectations in the market about what is RBI likely to do going forward, where most of the market participants were looking at probably March being the last of the action on the rate tightening. Clearly, expectations have moved into a April rate hike also being a base case scenario. We ourselves are no different. We are looking at a 25 basis points hike. Okay. And I think thereafter, the stance of RBI should largely become conditional on data. When I say conditional on data, both growth and inflation. And I think this time, with the kind of recent trend that we have seen on the CPI inflation front, inflation is likely to take precedence over growth, at least in the near future. And I think that is something that internally also MPC members, at least on balance, would gravitate towards, despite the division on opinion that is emerging out of MPC. But the division in opinion also tells us that probably we are nearing the end of the rate tightening cycle somewhere sooner than later. So it's only a matter of time that the terminal rate is achieved.
Okay, Madhavi, what about your take? The RBI has been on this aggressive rate hiking journey since May 2022, cumulatively raising by 250 basis points. What do you expect the rate actions going forward from here? Another hike going forward in the next policy?
So I think the world order has again evolved dramatically between the last policy and the minutes, and even at this point in time, where higher global and inflation prints plus the consistent repricing of the Fed terminal rate has clearly posed risk to emerging markets reaction function. Unfortunately, unlike the developed markets, emerging markets, most of the emerging market, I would say, do not really enjoy the tight labor market scenario that the West is now struggling with as far as the input to domestic demand is concerned. So I think we are closely watching the consistent global policy repricing, the pace of global inflation evolution, and even the case of impending recession. All of it, would eventually shape the DM central bank's monetary policies, which obviously will have implications for India. So I think back home also inflation is, at least the near-term inflation is fraught with some bit of uncertainty. Especially with the last print that came out, there were a lot of discussions about, whether the serial inflation was, input correctly by the CSO or not. But nonetheless, assuming that the number was indeed correct, probably the next print also will be a 6+ print in headlines, which will be the February print. And there's a good likelihood that the fourth quarter of FY23, inflation will probably overshoot RBI's revised forecast by around 50 bips, assuming again there's no past data revision that you may see. So that essentially will strengthen the case for the Reserve Bank to raise rates again in April. They have been very non-committal, and very honestly, central banks across the world have been. At least DM central banks or even emerging CBs have sort of indicated that incrementally the rate hikes will be slower, but nobody's saying that we are done, right? So I think RBI would continue to be very non-committal on future part of rate hikes, and they also sort of understand the global situation around is very fluid, and that may demand frequent macro reassessment. So I think to that extent, I believe that RBI probably would be sort of tied to the West in terms of how much financial sector disruption it actually brings to the world if the global repricing of rate hikes continues beyond May. Right, because early part of the year we were expecting that Fed would be done by March. Now we're talking about it spilling beyond May as well.
Sure. So higher for longer, and what could be the terminal rate then? I mean, like, are you also looking at a revision of that from your own end?
Yeah, so I think as Yuvika said that, in December we were like, we're done by March, but today sitting today, we all are talking about an April hike being, very high probability. And I think it could spill on to next policy as well, depending on how things pan out. But as I mentioned, the unfortunate part of the whole situation is that emerging markets, including India, are not having the same labor market dynamics as the West is enjoying. And thus, there's always a fear that we may over tighten, owing to the sort of compulsion that we are having versus the rest of the world. So I think to that extent that we need to offer a much higher, emerging market risk premium, we might end up tightening much more than required. But again, it's still very early to say whether we are done by April. So I think, as I said, RBI would be non-committal, and I think to some extent most of the economists are going to be, hesitant on giving a terminal policy point at this level.
Right. So that's pretty much changed the narrative in the last 2 months or so. Yuvika, what could be the potential threats to the GDP growth trajectory going forward? Is it going to be this over-tightening that Madhavi is mentioning? Are there other factors that could also have an impact?
Sakshi, I think one key risk, or probably two, if on top of my mind that come, are one, what happens on the monsoon. So as of now, if you see most of the assumptions that we, build our base case of growth or inflation on are assumed on a normal monsoon scenario. But we have global international climate agencies who are flagging off a considerable probability of an El Nino shaping up somewhere in the latter months of the summer. And that has implications for both growth and inflation. So that is definitely one risk that we'll be watching out for. The second, obviously, is on the commodities front. Although we have seen commodity prices soften considerably, and consolidate somewhat at current levels over the last few months. But there is always an upside risk to commodity prices, given the kind of geopolitical tensions that we see brewing in Asia. Also, because with China reopening, growth in China is expected to come back with much better vigor. So there is always this uncertainty on commodity prices that we might have to grapple with. And not to forget, one tailwind that is emerging is that now we are expecting a milder slowdown on the global economy front. And that also has implications for commodity prices. So I think for India, commodity prices and monsoon are two risks that have impact across both growth and inflation, and that will need to be very closely monitored in the upcoming months.
All right, Madhavi, you anything else apart from what Yuvika has said that is on your radar as well as a top concern?
I think to a large extent, as I said, my biggest concern is how bad is the global demand destruction is going to be and how it really spills onto domestic economy. Because as I said in the past that one isn't really clear as to how fast the core inflation deceleration is going to be in the world. And how much will be the global sacrifice ratios of output are going to be, and how deep and how prolonged the global recession are going to be, is something that is a big uncertainty for us from the global point of view. And of course, as she rightly mentioned, monsoons is those are more near term probably events, but I think on a more 1.5 or 2 year basis, I think how the global world turns out to be something that I would really watch out for very closely.
Right. Since Yuvika, you also pointed out the concerns, let's also focus on some of the tailwinds, like you also pointed out. One, the capex of 10 lakh crore rupees benefits will start to come in starting April as well. Can you dwell a little more on what could that lead to in terms of both tax buoyancy and also how soon do you see a pickup in the private sector investments? And can that be a bigger tailwind that one can bet on going forward in these macroeconomic concerns to offset these macroeconomic concerns?
I think, Sakshi, the budgets focus on capex yet again, and we have seen governments focus remain on capex in the last 2-3 years. Need to be seen from the point of view that the government does know the fact that the domestic growth, is set to slow down this year, and that is largely because of what is happening globally. And not to forget the impact of the monetary tightening that we've already seen, 250 basis points that you alluded to, is yet to transpire in the domestic or get passed on in the domestic economy completely. So in such a scenario, government's capex push does tend to add strength to the growth trajectory that we are looking at. So we need to see government capex from that perspective, that it's a strong pillar to support growth in an environment which would otherwise be pulling down growth in the domestic economy. If I take a step ahead and say whether it will be helpful to crowd in private investments, my answer to that will be probably private investments are likely to remain uneven and sluggish during the course of FY24. And why I say so is that while we have seen capacity utilization levels improve, we do not yet see a full-fledged recovery taking shape in the private sector. We do see, green shoots of private capex in some of the sectors. But in an environment where global growth trajectory is still looking to slow vis-a-vis 2022, we are looking at higher borrowing costs vis-a-vis last fiscal year. Export slowdown is something that is already taking shape in the Indian economy. It is very unlikely, despite corporates sitting on healthier balance sheets and despite banks also having cleaned their balance sheet considerably over the last few years, we do not see a private capex cycle recovering just at yet. We need better visibility, not just on domestic demand, but global environment looking somewhat more conducive than we are at this point in time. A lot of uncertainty. We still think it will be a wait and watch for a few more quarters before a more broad-based pan economy kind of a private capex cycle takes shape.
Okay, Madhavi, your take on this?
I think I agree with Yuvika on the same, because I do understand that nobody would want to expand their capacity at a time when there's so much uncertainty in the world on inflation, on growth, on sustainability of domestic demand. I think it makes sense for them to wait for a couple of quarters or even more before really, jumping on any kind of greenfield investment.
All right. Just last word from both of you then. You both talked about your Q3 and your FY23 numbers as well. What about the FY24? What is the number that you're working with that on? Madhvi, first you.
So I think somewhere close to around 5.7% is what we're looking at.
Okay, okay. And what about you, Yuvika?
We are slightly more optimistic. We are at 6%, but
Okay.
RBI's optimism.
All right, understood that. Well, thank you so much, both of you, Madhvi and Yuvika, for sharing with us such wonderful insights on where exactly is India's economy really headed from here on. Of course, we will get the GDP print tomorrow, and we shall definitely connect back with both of you to really understand the fine print of those as well going forward from here in terms of the sectoral breakup also that we get, and in hopes of whether we're expecting it's on the expected lines as well going forward from here. A lot of headwinds, but a few tailwinds as well. We'll just have to wait and watch to find out how things maneuver from here on. But many thanks for joining us and sharing your insights with all our viewers ahead of the Q3 GDP print. And with that, we wrap up this edition. Many thanks for tuning in, but do stay tuned on to Business Today TV for a whole lot more coverage on the world of business and stock markets as it continues right up next for you. Many thanks.
If you like the video, do like, comment, share and subscribe.